In the last video, we talked about how to calculate the bond price. Well, if we know the bond price from the markets, we also need to know how to estimate our return if we buy the bond at the market price. So that's why we are trying to study the yields and try to understand how to estimate bond yields or say the return from the bond investments. We will try to look at the yields from different perspectives or say out of different concerns. We'll start with the current yield. Current yield is simply the bond's annual coupon payments divided by the bond's current market price. So if you are paying this market price to buy this bond, and then every year you are receiving, say, $50 coupon payment from the bond, then you are using $50 divided by the price to get the current yield. So essentially it's about the return from the coupon interest payments alone. But we understand if you invest in a bond, you don't just get the coupon payment. If you hold the bond till maturity, you will also receive the $1,000 final lump sum par value payment. If you sell the bond before maturity, you will get a price of the bond. In that sense, current yield itself does not measure the total return because it does not account for the final lump sum payment, the capital gain or losses that would occur. So if we want a more comprehensive measure of the return from the bond investment, we are looking at another measure which is called yield to maturity. The yield maturity is about the total return that investors can get if they bought the bond at the particular market price and hold the bond every year till maturity. When you buy the bond at that price and then you hold it till maturity, you are receiving an annuity of the coupon payments and you are receiving the final lump sum payment, the par value. So then you are trying to look for a discount rate that makes the present value of all your future cash flows all together match the price that you pay. In other words, you are solving for this little I so that your bond price would equal to the total present value of all your future cash flows from the bond, including this annuity and the final par value payment. The calculation itself actually can get pretty complicated, especially if we have a long-term bond. But with your financial calculator, it can be actually pretty easy. So I'll show you how to calculate the yield to maturity by some examples. In this example, we have a 4.3% coupon bond, 14 years left to maturity, and we know the price, $943.22. So the question is, what is the yield to maturity? As an investor, you would pay this much to buy this bond, and then if you plan to hold this bond till maturity, you have 14 more years. So every year, you're going to receive some coupon payments based on the 4.3% coupon rate. And also, at the end of the 14th year, you'll receive $1,000. So 28 payments because that's 14 multiplied by 2. Each payment is $21.50, and that is based on 4.3% multiplied by 1,000 and then divided by 2. Future value will be 1,000. That is your final lump sum par value payments. Your price is this much. And you do notice here we are using a negative number here as the price because that's how much you have to pay. And then these two numbers, payment and FV, these two will be positive because they are both what you can receive. So what you're paying versus what you can receive. Now we can figure out the return. You compute for the I, your calculator will tell you 2.432. That is telling you the interest rate for every 6 months. semi-annually, right? So every 6 months is 2.432%. Then, as the last step, you have to use the 2.432% multiplied by 2 to get the annual yield to maturity as 4.86%. So yield to maturity is always an annual figure. So if you get your result from your calculator as the 6 months IY, you need to multiply your IY result from the calculator by 2 to convert it to an annual yield. We say bond prices and the yields provided by those bonds, they should be inversely or say negatively related. Well, the idea is simple. If the price goes up, then to pay the higher price to get the same bond, that means the return for the investors will be lower. And if bond price goes down or say falls, the return will go up. Because if you get to pay a lower price to buy the same bond, then that means for you the return actually potentially can be higher. So again, bond prices and the yields are inversely related. Also, if we are looking at bonds that are selling at discount, remember those are the bonds with a price lower than the par value, their yield to maturity would be greater than the coupon interest rates. And for bonds that are traded at a high price, a premium price, or say a price that is above the par, their yield to maturity actually will be lower than the coupon interest rate. The next issue we want to mention about the bond yields is about the muni bonds, the municipal bonds. You will notice that municipal bonds generally they offer lower yields. We're talking about the yield to maturity. And that is because the interest from the muni bonds is tax-free. And that's actually something we talked about at the beginning of this chapter. So here, let's look at some numbers. If you have a muni bond that has a yield of 5% and a corporate bond with the same level of risk that has a yield of 6%. So if they have the same level of risk, they are supposed to deliver the same level of return. But now you're looking at a 5 versus 6. And does that mean this corporate bond is better than the muni bonds because 6 is better than 5, right? Not necessarily. For example, if the investor is paying a 30% marginal tax rate, then after tax, his 6% return from the corporate bond actually will be 4.2%. That's 6 multiplied by 1 minus 30%. So 4.2% apparently is actually lower than the 5%. 5% from the muni before tax is 5% after tax because it's tax-free. So we have to compare the after-tax return between the muni bonds and corporate bonds, and that's why we have to understand the tax implication here. So now we are looking at something called equivalent taxable yield. And the formula says the equivalent taxable yield is the yield provided by the muni bonds divided by 1 minus the tax rate. Notice for different investors, this tax rate can be different. For example, we are looking at a muni bonds of 5% and an investor whose marginal tax rate is 35%. And then we follow this formula and we use 5% divided by 1 minus 35%, we get 7.69%. What exactly does this 7.69% mean? Or say, what exactly is this equivalent taxable yield about? 7.69% means that for a corporate bond to be equivalent to the muni bonds on an after-tax basis, before tax, this corporate bond has to offer at least 7.69%. And because of this tax-free feature, muni bonds are more attractive to high-income investors who usually have high marginal tax rate. Let's look at another practice question. If we have an investor, marginal tax rate for him is 33%. He's looking at a muni bond that has 4.5% return. So 4.5 for the muni is before and after tax. And then a corporate bond with a 6.5% yield. That's before tax. So which bond would give the client more profit or say higher return after tax? According to this equation, you use the 4.5% muni yield divided by 1 minus t, you get 6.72%. It means a corporate bond with the same risk should offer at least 6.72% before tax. Otherwise, after tax, it would not be as attractive as the muni bond. Now, because this bond only offers 6.45 before tax, which is lower than this number, then this corporate bond simply is just not good enough. And then the client should just take the muni bond because after tax, the muni delivers a little bit higher return here. So we just talk about different return or yield issues for bond investments. Now let's talk about the risk in bond investments. We're looking at the so-called credit risk. Credit risk is the risk that the borrower will default on the bond and they would not be able to make the interest payment and also the principal payments. If we want to know how much credit risk this bond has, we can look at bond ratings. So bond ratings are used to measure an issuer's credit risk and help investors to understand the likelihood of the bond be repaid or the likelihood of the issuer going bankrupt. So ratings usually are issued by the rating agencies such as Moody's, Standard & Poor's, and Fitch, and they monitor the bonds and they report their findings based on many factors such as the issuer's financial condition. So you can imagine if Southwest always lose money, always shows negative profits, the rating cannot be high. And also general economic condition. If the economy is in recession, a lot of companies will go busted and they will not make the debt payments. Also the collaterals. So if a company use a lot of asset as collateral against their bonds, so then if the company is not doing so well, they can sell those assets to get cash and still be able to make the bond payments. So in that sense, if they have some high value collaterals, those bonds would have a little bit better rating. So you may notice that if you look at some bonds, they come with the ratings such as BBB or CC. We can try to understand the meaning of those ratings. For example, AAA issued by Standard & Poor's, usually they stand for highest rating, and that is telling you that those bonds with AAA ratings are generally considered to be very safe. Now bonds with CC ratings, they are considered highly vulnerable. So it's very likely that those companies cannot make the interest or principal payments, and very likely they will go bankrupt. So generally, if I draw a line between the BBB and BBB minus here, so bonds with above BBB rating, like AAA or A, BBB, these are considered investment grade, usually considered safe. However, if you are investing in bonds that have, say, a BB rating or even lower rating, you are investing in those speculative grade or junk bonds. So if you see the name junk bonds, you understand the quality of those bonds are not very high, and you are taking a lot of risk. And generally, investors would only buy these bonds if they offer very, very high return. So junk bonds have to offer pretty high returns to attract investors. Now, if you are managing certain portfolios, such as a pension fund, which needs to be pretty safe. You will not be allowed to invest in those junk bonds because of the high risks involved. We also need to understand that even when looking at the same company, when they issue different bonds, those different bonds issued by the same company may have different ratings. So it really depends on what's promised or what's specified in the bond contract, or what we call as indentures. We have debentures, which are unsecured corporate bonds. By unsecured, we mean those bonds, they are not backed up by assets, or say the collaterals, and they are only backed by the reputation and the ability of the company to pay back the money. On the other hand, we may have mortgage bonds, or what we call as equipment trust certificates. Those are bonds secured, or say backed up by the collaterals, usually in the form of, say, some buildings, some equipments that the company has. So if something bad happens, the company actually can sell the building or the equipment to come up with cash and pay for the bonds. Generally, unsecured bonds are more risky than bonds with collaterals. So the unsecured bonds will have a lower rating comparing to the secured bonds issued by the same company. Also, if we look at the bonds issued by the same company, we may have senior bonds versus junior bonds. Now, the senior versus junior bonds here have nothing to do with the age or maturity of the bonds. A senior bond simply is by design or by contract has a superior claim on the assets or the income of the issuer. If the company has some kind of financial problem, the senior bondholders will be paid first, or say be paid earlier than the junior bondholders. That means they have less risk. That means those senior bonds may have a little bit higher rating comparing to the junior bonds. So again, the idea is, depending on what the company promises, when they issue different bonds, those bonds may come at different level of risks and therefore have different ratings. As an investor, if you are trying to buy some bonds issued by a company, you have to do the homework and try to understand what comes with the bond and what kind of risks this bond has. Bond yield is affected by the credit risk of the bond. So generally, if we have a high quality bonds, the bonds come with pretty low credit risk. Those bonds will offer pretty low or lower yields or return. If we have lower quality bonds, the bonds with very high risks, they have to offer higher yields. Remember, we just mentioned that junk bonds actually have to offer pretty high return to attract investors, because otherwise, why would investors invest in those junk bonds? We can also look at this yield to maturity graph for different kinds of bonds and understand this relationship between credit risk and yield. So in this graph, we are looking at the return from treasury bonds in blue, and AAA rating corporate bonds in orange, and BAA rating bonds in green. And we do notice that from 1980 to 2015, all these years, treasury bonds offer the lowest return. Remember, at the beginning of this chapter, we did mention that treasury bonds, they are considered the safest investment in the world. And because of that, the return, the yield they offer is also very, very low. Now, if we are looking at the BAA bond, which is okay, but still more risky than the AAA corporate bond or the treasury bonds, you see they have to offer higher return than the treasury bonds or the AAA bonds. Again, generally high risk, high return, low risk, low return in the bond market. So by now we have finished chapter 7, and we have tried to look at a lot of features about a bond and try to understand some terminologies of bond and bond investments. We also discussed different bond issuers and different types of bonds. We look at TIPS, and we try to calculate how TIPS payment is adjusted by the consumer price index and understand how that helps to protect investors from inflation. We also try to calculate bond prices for different kind of bonds, including zero coupon bond, fixed coupon bond based on annual compounding, or semi-annual compounding. Based on our calculation results, we talk about the concept of the interest rate risk and reinvestment risk, and we discussed what kind of bonds are more subject to interest rate risk or what kind of bonds are more subject to reinvestment risk. We also try to calculate bond yield, including current yield, yield to maturity, and also specifically for municipal bonds, the idea of equivalent taxable yield. And we talk about the risks of bond investments, specifically the credit risk, and how investors can use the credit ratings to understand the credit risk of a bond investment. So hopefully after this chapter, you get some basic understanding about bond investments and some good idea about calculating bond price, estimating bond return, and also understanding the risks in bond investments.